Your next guest has some ideas on how to best capitalize on these massive investments. Joining us now is Tim Urbanowicz. He is Chief Investment Strategist at Innovator Capital Management. I'm assuming you're not going to say bet it all and hope for the best on blackjack.
That's right, Brian.
I mean, that's a winning strategy for some lately.
For some.
Okay, so let me ask you this. First off, 500, whatever, trillion, billion, it doesn't matter what the number is. Is it going to happen? Are you confident? You really believe all that spending is going to occur?
I think it's a big question mark, Brian, but we see that as more of a concern for 2028, 2029. What we know right now is that we are in a situation where demand continues to far outweigh supply. You look at the comments from Meta recently. They're going to increase their spending 50% next year, 35% the two subsequent years after. So this is a pocket of the market we want exposure to. We do, Brian. We think a lot of the easy money has been made in a lot of those big hyperscalers. We want to start going down in market cap. In our Frontier Tech ETF, we're focused on companies $500 billion or less. We think those stocks have a lot of room to run and continue to enforce leaning into those infrastructure stocks.
Okay, and I know a lot of these names, they get talked about ad nauseum. I get it. So let's try to bring our viewers some new-ish names. One of the companies you like is called Celestica. CLS, the ticker. I've heard of the company. I know they're kind of a contract manufacturer. That's about the extent of my knowledge. Why do you like them?
Think about them as a partner for a lot of the hyperscalers. They're building a lot of the hardware switches. Another one we like, ticker VRT. They're also involved in a lot of the data centers. They do the cooling, heat rejection. We think these have a lot of room to run. Both are trading right now at about 40 times earnings, which sounds expensive, but we look at that the next year. We look at the growth rate, all of the spending, again, Brian, that we're projected to see. That's why we like a lot of these names. Not to say that the mega caps are going to sell off. We still think that's a place to be. But looking outside, we see more upside.
Well, maybe that mega cap name trade is, I don't want to say played out, because that implies there's a top. It's not my job. I don't know. Maybe you can address that. But we often are now, or maybe I don't say we forgot, but we're remembering now that to build a data center takes a lot, to your point, of heat, of cooling, of water, the skeleton of the data center, if you will. And in part, that's what Vertiv and Celestica do.
That's exactly right. And that's why we like them. Yeah, there's going to be a tremendous amount of spending here. But when we take a step back and you look at the market broadly, there's no doubt, Brian, that we've seen valuations run up in a big way. AI has been a big part of that. But when you look at the data historically, high valuations do not tell us the market is going to sell off. It's a horrible timing tool over the next 12 months. I think as an investor right now, what you need to be thinking about, how did you maintain exposure, but also manage your downside risk? Because as valuations go up, as excitement over this AI trade goes up, that means any news contrary to the narrative, any bad news, really magnifies the downside.
Is it bad news, or would it even just, at this point, with valuations in the run, be less than hoped for good news?
It is.
Could good news actually be sort of bad news? Because it doesn't have to be good. Some of these companies need great.
100%. And if you look at the beginning of the year, we had a target on the S&P 500, 6,700. We're pretty much right there right now. And we would say for the next, the remainder of the year, we think upside is somewhat constrained. And a lot of that has to do with the starting point. It takes a lot of good news and significantly better news to continue to propel stocks at the rate that we've seen over the last year. So you look at the rest of this year, next year, I think the expectation is for slower returns.
Yeah, what's going to matter more? Is it going to be the AI story or the Federal Reserve?
Well, both are very important.
Sure.
The Fed is incredible.
They're both important, but let's be clear. I think the AI trade is much more important.
I think the AI trade is important. I think you're seeing very strong earnings starting out so far. But I think what concerns us a little bit, and you see interest rates coming down today, we're a little more concerned about the intermediate longer end of the yield curve, with the Fed cutting interest rates, Brian, into an environment where we still have core inflation north of 3%. That's concerning. That's not typically an environment, in fact, almost never an environment where you see the Fed cutting interest rates. They're getting a lot of pressure to do that, but you don't want to see a situation where growth really heats up and we have to start dealing with a situation like
Jerome Powell